Hello, Brokers Are Better Facebook community. We are going to get started here. We have Ari Karen. Ari is the managing partner of Strategic Compliance Partners. He's also works for Offit Kerman as a partner. His specialization is in mortgage compliance, RESPA, and just general mortgage regulatory legal. Is that correct?
I think that's correct, yes. All that kind of fun stuff.
Absolutely. So obviously, everybody loves compliance.
You know, I do refer to it, Anthony, as the C word.
Me too. So Ari, there's, obviously right now, I think we talked a little bit earlier about this, because everything's shut down, not a lot of, examinations going on at this specific moment. But a couple of things we want to talk about today is we want to talk about the forbearance part of things, because this is definitely something that you spent a lot of time in. I think there's a lot of concerns. I know there's a lot of concerns for brokers when it comes to the potential of compensation recapture or forbearance resulting in a early payment default that results in their compensation being recaptured. I've explained, some of the economics that are going on around it. I've also explained that at this point, we've done a pretty strong job from AIME's perspective, communicating with our lending partners, and they are all, at this point, not, enforcing this at a high degree. If they see like a serial offender, that's a little bit different. But at this point, we're not seeing an overwhelming amount of enforcement. But still, it's something we need to be concerned about. So let's talk about that. What are your thoughts on the forbearance?
Well, I think, look, one of the things with the issue with the forbearance is the real concern is going to come a little bit down the road, right? So in other words, you had the forbearance go into effect. A lot of lenders started essentially requiring notices and things that would dissuade people from almost closing loans because, or taking the position saying, hey, your loan isn't entitled to forbearance, because if Fannie wasn't buying it, then really it doesn't become backed as a federal loan, and therefore no forbearance exists. Now, yesterday, that was kind of a strategy that was going on, took a bit of a left turn. FHFA, I believe, Fannie put out something saying, we're going to buy these now. Even if they're in forbearance, we're going to buy them. However, we're going to have I think it was like a 700 basis point hit to pricing, which obviously is massive.
Well, not even pricing, just that's basically a one-time, it's like a type of situation.
Yeah, right, price adjustment, the LLPA. So, interestingly, I think it kind of helps the broker, because now it's at least Fannie buying it. So I think the argument that you can hit somebody with an EPD, which then ultimately flows back to the broker, right, it does go down, because at least they're getting paid on the loan now. The loan's being sold, right? So I think that helps, but it doesn't eliminate it. And I think now, where I'm already started working with some lenders on kind of strategies and how we're going to do it, I think ultimately what I think is going to happen is that we're going to just see a price adjustment, because there's almost no way the way they wrote it up, that you can stop this from happening, right? I mean, if somebody seeks a forbearance, you got to give it to them. And I don't think people can say anymore that your loan isn't isn't entitled to a forbearance when, and he's buying it. So
there's no hardship requirement on forbearance, so anybody's eligible for forbearance. I think right now the two issues that we've talked about is some brokers have brought up the topic of, hey, I'm going to send something to my client, or I'm going to have my client sign something at closing, that basically them acknowledging that if they go into forbearance, that the broker's commission gets recaptured, and there's some type of you'll have to pay this. And what I've tried to explain to brokers is, we're not a lender, and we can't impose a restriction on something that's federally mandated. Like, the federal government has basically passed the CARES Act, and forbearance without hardship is not only permitted, and even as flawed as this may be, it's the law, and we can't sit there and try to be like, a cowboy and say, okay, we're going to put our own prepayment penalty on this that the lender doesn't know about, and we're going to override that. That's just not the way it works. We just have to, unfortunately, really educate the consumer on this situation. I personally look at it, I say, like, of the individuals, the consumers that have asked for forbearance, I think there's about 5 to 6% of the overall portfolios of loans out there are now in forbearance. Of those loans, 97 or 98% are loans that funded prior to January 1st of 2020. So, people that are buying homes in the last 30 to 45 days or this year to date, for the most part, are not the people that are losing their jobs. The people that are losing their jobs, if you just look at the jobless data, are in the service industry, in the retail industry. They're probably not a lot of the consumers that are being impacted by forbearance right now. To be honest with you, there's probably not as many homeowners in that percentage. Just being real about average household wages of those individuals. So with that said, I've been trying to demonstrate to the brokers that the likelihood of a forbearance is probably one out of every, realistically, maybe 30 or 40 loans has a chance of going to forbearance. So, to me, if you do have a compensation recapture, you kind of have to look at it as a cost of doing business for this short period of time.
Yeah, and I do think now, though, there's a couple things that people can do. So look, now that there's literally an LLPA for that, right? A price adjustment, loan price adjustment is that I'm probably going to be recommending to lender clients, which I think is the same thing I think brokers might be doing. Feel like you go through the whole: have you requested forbearance? Has your job been changed? The typical questions you would ask, just make sure that this person isn't already not eligible, but having something going on that would affect their ability to pay, right?
I don't think it's asking for the forbearance. It's really just asking, like, it really comes down to, if you're closing a loan, the lender is going to validate that they're employed. So, like,
correct,
you don't have that hardship. So it really just comes down to, having the conversation with the consumer as you're going through the process of, this is what you might hear about what forbearance is. This is what it is. You don't skip, you don't have to pay payments, but you do have to pay them all back at the end of the forbearance period. But more than anything, I think the biggest educational piece is helping them understand that this, by doing a forbearance, could prohibit them from being able to refinance in the near future, because a lot of lenders are looking at this as a credit event, and they are looking at this the same way that they have looked at loan modifications, and they've looked at short sales to a degree. It's just because you're in forbearance, and just because that doesn't impact your credit, you didn't actually make your payments during this period of time. And that's, from an underwriting perspective, is going to be something that they look at.
One thing also that I think you could focus on now, based on what happened yesterday, is almost saying to the borrower, and this may sound strange, but it's a strategy, is, hey, you can close this loan even if you're in forbearance. So if that's something you're going to do, you may want to tell me, just to be sure you can get it, which sounds really strange. But here's the thing. Remember, that would be a change in circumstances for which you'd be able to have a price adjustment. So you come back to the borrower and say, hey, now your percentage is higher.
I don't.
That's just a strategy people may be thinking.
I honestly think it's a very slippery slope, and to me, it's really not a price adjustment. It's really it's not something that lenders are going to put on the rate sheet. It's something that lenders have to pay if that event happens. So, like, if a customer asks for a forbearance before the loan closes, or mentions that they're interested in going to forbearance before the loan closes, nobody's going to close that loan. Like, that's no lender going to close that loan. So, like, that's a dead deal. But if after the fact the loan's funded, you've been paid your commission, and they ask for a forbearance, right now, my understanding is that if they want to securitize that loan in a Fannie or Freddie pool, they then pay the 700 basis points. So, the reality is, if you're a broker and you were paid 200 basis points, and the lender on day one of before a payment's ever been made has to pay out 700 basis points to securitize that loan, they're going to recapture the compensation. Like, that's a net loss of 500 basis points, no matter what.
Yeah, no, I think the key is what they're trying to do is sniff that out before it closes, right? So if somebody comes and goes, oh yeah, as opposed to somebody thinking about, oh, I'll do this after the loan closes. The idea is that if I almost encourage them to tell me beforehand, I can make sure I don't have to close that loan, as opposed to somebody thinking, oh, well, I'll just close the loan and then tomorrow I'll call it. So that's sort of one of those strategies some people are thinking, to almost encourage finding that out now and then doing what they need to do later. So that's sort of a strategy. Seeing people, if that makes any sense, because you're correct.
So let's shift gears here. Let's talk a little bit about, we talked a little bit about the LOA this has been a question that comes up, is what is the, kind of line in the sand where an LOA has to be licensed? Like where can their where do their responsibilities have to start and end in order for them to either be licensed or not be licensed? So talk to us a little bit about that.
Yeah, because that is an area of that people get hit on a lot on exams. People who are not licensed, either not licensed in that state or just not licensed at all. Look, my take on it is get your LOAs licensed. I think it just gives you flexibility, because here's the problem. I mean, you got to be really disciplined as an LOA to not cross that origination line. The definition of originate that most states go by is the definition that was put in the changes when they updated Reg Z, I think in 2014. And essentially what it says is that if you are speaking to a borrower about a potential loan scenario, or a potential borrower about a potential loan scenario, anything specific to them, then it would be considered licensed activity technically. So if you just say, we have the lowest interest rates in town, besides the whole advertising piece and, UDAP, and I'll put all that stuff aside, right? But if you just made a generic statement, or like our current interest rates are 4.25%, some type of generic statement, if somebody that's not specific to a borrower, then that is not originating. But for example, if somebody says, well, I had a foreclosure 2 years ago, can you guys do loans for people like that? And you say, oh yeah, no problem, you're originating. So when you think about what an LOA does and when they're involved in the process of talking to the borrower, how is that really not going to happen too many times, right? And I think it also, from a customer service standpoint, enhances your position. Because you're talking to a consumer. Do you really want to have your person as your LOA saying, hold on, you're going to have to speak to Joe about, the fact that you want, an eighth of a change, anything that could come up on a loan. Oh, you want to change your loan amount? Hold on, let me get Joe on the phone. That's tough. That doesn't enhance the sales experience. So to be able to have that freedom to have them talk to them about whatever they want to talk to at that time, and not have to have that break in conversation, I think it enhances the sales experience for the broker to have the LOA licensed.
What about so your recommendations, kind of you're on the side of caution and basically get your LOAs licensed if you can. Like that would be the ideal situation.
Yeah, and it's not just compliance. I mean, yes, it's compliance, obviously, but it's also at some point, that you're going to cross into licensed activity with an LOA talking to a borrower, and you want to probably have the LOA be able to do the most they can and also facilitate that transaction. And so I think it actually enhances the business to have that LOA seamlessly be able to talk to that borrower when you may not be available.
Right. Just simply if the customer calls and has a question, or actually, here's the scenarios. If a restructure is required on the loan, appraisal comes in short, something happens where you have to restructure the loan and it impacts the rate, the ability for them to properly go through a full restructure and discuss interest rates. You can't do that if you're not a licensed LO.
Correct.
So from a perspective of compensation, this is one question that's come up a lot when it comes to processors, LOAs, paying them on a transactional basis, meaning, they receive a salary, but for every loan that closes, they get a $50 bonus or $100 bonus or something like that. What is the line, or what is the stance on that?
I don't think there's any problem with that when you pay an LOA. Obviously, look, for every state wage law, you're going to have to pay them some type of base compensation. It can't be 100% that. So I think that's fine. Where I think some brokers get into some trouble is that they have one of their loan officers make the payment to the LOA. So they say to the loan officer, you can give the LOA a bonus, right? I think you get into a lot of problems there. Not only is there a lot of compliance issues, but I think from a business owner standpoint, one thing I've seen when you have that structure is you have a self-contained team, and that team then becomes loyal to each other and not to you. And so if somebody leaves, that LOA goes with them. So you almost have now a team within your team that becomes very transitory. So I think that's a mistake. That person becomes loyal to LOA, not to you. And as the company owner, that's never a good thing.
Yeah. And what about from a standpoint of, I've heard, different organizations, and not just broker, but I've also heard retail lenders where they have, sort of this, they give their, like, I want to say they allow their employees to have expenses that are paid through the company, cell phone, car payments, stuff like that. Is there any type of compliance, concern there? How is that viewed? What are your thoughts?
So it's in the setup. I think that's actually in some states you actually have to do that. Like for example, California and Illinois passed laws when you had the Trump tax reform that said now you can't because now employees can't get reimbursed or have limitations on being reimbursed for business expenses. Now these states have said you have to provide employees expense reimbursement for things necessary to the business. So I think setting something up like an expense account where part of their comp they can delegate to this expense account. So for example, somebody having 150 basis points and you say, well, tell me how much you want to go into your expense account. And they say 25. Okay. So every time they close a loan, 25 bips goes into that, something like that. And then they can pay those expenses from that if you set it up correctly. Again, this is one of those things, don't do on your own. Don't do if you stayed in a Holiday Inn last night, right? Have somebody who knows what they're doing, set it up. It's very easy. It's very fast. It's right in a paragraph. You know how to do it. And then you've got really a self-contained way. And here's the great thing. You as the business owner can get the tax reimbursement for it. So not only do you not pay more in comp to the employee, because again, you were still paying 150, right? Now 25 is just going to this expense account. But now you can also deduct that on your taxes as business expense.
But so as those expenses, they have to be legitimate business expenses. They have to be things that are tied to the business. So, is a car payment something that can be tied to the business? Like what's how do you define that? Cell phone, like what is the process of, is it just subjective, or how do you identify business expenses?
Yeah, I'd love to give you more specific stuff, but I'm an accountant and I really don't know that stuff because that gets into internal. It's based on the IRS and the state code, usually based on the IRS code. Most accountants can tell you that. I think the key is, I believe that the car payments could be, but I think it's something that a big key to is consistency, right? So it can't be you closed all the loans this month, we're going to make a car payment, right? It can't be something like that. There has to be consistency to it. But I think that, look, I think if your job is to drive around, right, and meet borrowers and realtors and that kind of stuff when you don't have the coronavirus stuff going on, of course, right? Then I think, you could probably make a pretty good argument that that's a legitimate business expense. So, cell phones, absolutely. So I think a lot of those things, it's when you get to stuff like, basketball tickets, right, or football tickets, like. Now we're starting to get really touchy, and that's when I would definitely say start talking, your boat, right? Start to talk to your accountant now, right? Because I think this is starting to get a little hairy.
What about on the one question that's come up is, are you dealing with any situations where you have somebody that has a line of credit, a warehouse line of credit, and I've seen it been involved in a lot of these email communications where the loan is funded by this is a mini correspondent, loans on the warehouse line, VOE gets done, and the person has been laid off. So now the lender says we're not going to buy the loan. How what kind of position is that company in at that point? Because your warehouse lender is only going to let you keep that loan on the warehouse for X amount of days, usually 30 or 45 days or something like that. So now they can't sell it. They probably have to turn to the scratch and dent market. But from a legal perspective, that's the exposure you take on when you have a line of credit and then you become a minicorp, right?
Yeah, that, and one thing I would say, be very careful on people if there is any takeout for non-QM anymore. I don't even know if there is, but people are getting killed on the non-QM side of it because there's no scratch dent, right? You're sitting with that loan and there's nothing you could do. And that's kind of, Anthony, going back to my point of almost to avoid being in that situation, it's almost better if you could sniff out the borrower beforehand to not be in that, right? Now, I think that has improved because of what happened yesterday. You're going to have a takeout now for it. It's just you're going to get clipped hard.
Yeah. But the thing is, minicorp are not. That's a whole different situation because like you have to be Fannie or Freddie Direct in order for that to matter. If you're just a minicorp, you're selling to you don't have the ability to sell it through the cash window to sell to Fannie or Freddie.
No. Well, I guess my assumption is that people will still buy the loan In other words, right, because there's now at least somewhere for right, and so that'll flow down is my expectation. It may not, right? Somebody may say, "Hey, I'm not taking 700 basis points. This is your problem," and you're right. I don't know how that's going to work, but
Well,
I understand.
and I guess we'll finish up with this on taking a long-term perspective. So I know people to this day that are still dealing with litigation from Lehman Brothers and from
I'm
financial.
still dealing with, yeah, I'm still handling a bunch of those cases. Yeah.
So one of the things I've talked to brokers about is, I obviously have been in the business since 2003, and I went through that period of time. Luckily, I didn't own a company before before the financial crisis. So, when we think about these issues that are coming up, whether it's forbearances, these reps and warrants, that may or may not be enforced by the current lender. If a lender goes into bankruptcy, as we saw with Lehman Brothers, and an audit's done and something related to those loans can be tied back to the loan processor or the loan originator or the broker, and there's a rep and warrant, concern there is trailing liability that can go on for quite some time is what we've learned through the Lehman Brothers situation.
Absolutely. Look, I'm litigating some Lehman cases for clients right now we're going back to loans from 2007. I mean, absolutely, because the way that they structure these contracts, there's an indemnification clause that clause doesn't get triggered until the lender takes the loss. So if it takes, 5 years to go through foreclosure and all these other things, right? And you could see certainly with the coronavirus right now, how that's going to delay everything. You could be dealing with this stuff. We're going to be dealing with the ramifications of these forbearances for years to come.
Yeah, because I mean, right now I saw a statistic that said if basically Fannie and Freddie are kind of forecasting that only 10% of the people that go into forbearance will come out of it and get back on track. So 90% are not. And the reason why I kind of want to make sure brokers understand the long-term ramifications is you don't like there's your current lending partner. You don't really have to just worry about them. You have to worry about if anything goes wrong and they were to go out of business, when the bankruptcy trustee or whoever is taking over their essentially their, I guess, liabilities or their collection of their assets or debts owed, they're the ones that really come back and will leave no stone unturned, because at the end of the day, every dollar they uncover is something the legal teams are able to capture a portion of that money. So you have to be extremely conservative during periods of time like this, where hey, listen, customer tells you they are thinking about closing and then asking for a forbearance. Customer tells you that they lost their job or they may be losing their job. It's better to not close a loan now, and you might not get paid on the deal, but these issues, if 90% of the people that go into forbearance don't come out of it, these are going to be things that you're going to be dealing with. It might be 2 or 3 years before you deal with it, but when you deal with it, you're going to be dealing with it.
Yeah, and it's not only just bankruptcy. I mean, think about it. Businesses are going to get sold, right? So business A gets sold to business B. Business B has no relationship with you, doesn't care, and sees on the books, that hey, we have some contingent liabilities, and if we could squeeze even X% out of it, we've reduced our sales price, right? I mean, when people do mergers and acquisitions, these are the things you look at. So I think you could have liabilities arising from that. But I couldn't agree with you more about what you're saying about, it may sound real great, close the loan today and worry about the problem tomorrow, but that mentality can lead to a whole lot of problems tomorrow when they come. They don't come they don't time them out perfectly for you, right? And so one thing, and there's going to be a lot of legal issues. Are these loans subject to default? Or I mean, lots of things. One thing you want to look at on these issues, if you are interested or concerned about it, is actually look at those TPO agreements and the reps and warrants you make. Because one thing you may be able to do is, if you can create enough documentation, and that was something that I think you really have to look at now, is tailoring that documentation to what your TPO agreements are. Then you actually may be able to protect yourself downstream, as long as you're not doing something where I didn't hear you say that, la 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 la, right? That kind of game, yeah, it's going to get you in trouble. But there may be also ways to really protect yourself, because let's be honest, Anthony, it's not just the la, 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 I didn't hear you say that. There are a lot of times brokers get hit on things that they couldn't have known about, right? But they're vulnerable because of the TPO agreement. And if you can go back in time and say, well, what documentation could I have gotten to say, hey, wait a second, this can't put this one on me, right? That stuff can actually be very helpful down the road, because even if contractually they can put it on you, I've noticed that when you're actually negotiating your way out of these situations, to be able to say, look, I have this document they signed and it said X, and you're coming to me on this, and I understand maybe you could say the borrower lied and that makes it, but there's different situations that lenders don't love taking, unless they're the investors really are the ones who drive these, right? They don't love, the investors don't, I don't think, love taking those cases all the way, right? They're the ones where you can sell out for a lot cheaper in terms of settlement than the ones where they can say, you guys knew and you didn't do anything about it.
Yeah, I think the bigger issue is just understanding like aggravation tax. So like to me, it's like, like, realistically speaking, if you get into any type of situation 3-4 years from now on one of these things, one of two things is going to happen. A, it's going to be a massive distraction. Even if you have to like hire an attorney and defend yourself, you're going to pay out more in legal fees than you're going to make on your commission today. And B, I also think it's really important that like everybody understands now the difference between now and the financial crisis is we didn't have MLS and we didn't have the structure that we have now, where both loan officers and the broker owner, the brokerage, are going to have, this, their names tied to these loans into perpetuity. So the ability to understand that, like, it's easy to identify who you're going after. And all bets are off when these companies come after you. Even if they have no grounds, or even if you did everything right, you still have to defend yourself, and that's a big aggravation. That's why it's just, sometimes it's better to be, really, really diligent, be thorough, have a clear understanding of what's going on before you fund a loan. And we take that for granted sometimes, but I think right now it's an easier time to understand like the risk. It's like eyeball test is understanding like, hey, my client works in the service industry or a retail industry or whatever industry that could be vulnerable to an economic shutdown, versus my client is, an attorney or works for a big corporation. So just things to think about, I would think. Anything here in closing? Obviously, Strategic Compliance Partners is a partner in the Brokers Are Better vendor network. We have a lot of brokers that use the service. To just kind of describe it, it's an all-in-one compliance policies, procedures, handbooks, in on-demand service for customized to each broker that uses the service. Correct?
Yeah, essentially, we have a broker package which gives the broker, especially starting brokers, really that first year of all the information they need, so you don't have the the surprise moments excuse my French here, but the oh shit moments, right, that happen to people. It avoids that because you're kind of set up and you know what's happening to you. And we also provide updates of things going on so people could stay abreast of industry trends, compliance trends. So it's putting them ahead, and really allowing the brokers to focus on their business as opposed to focusing on compliance.
Yeah, I mean, we communicate with such a large number of LOs that are, usually making the transition from retail to broker. And, when they're starting the broker shop, a lot of people, their number one concern is this fear of compliance and this fear of like this overwhelming, hey, am I going to be able to manage this? And obviously once people get through the transition and get, their arms wrapped around everything, they understand it's not, as long as you do everything appropriately and have all your ducks in a row, it's not that overwhelming of a burden. But I think what you guys really do is you ensure that from day one, hey, here's your broker in a box compliance, everything A to Z, you're covered. And then as you mature as a business, you sort of mature what you offer.
Correct. That's correct. Exactly. Look, another way to look at it is I sometimes use doing breaks analogy, right? Could I do my own breaks? I guess so. It would be fairly intimidating, kind of scary, and I hope I do it right. Whereas you could just have a mechanic do it and it's done right and you move on with your life and you don't really worry about it too much. That's kind of an analogy also to look at it, right? So that's something, could you not do it? Yeah, I mean, could you do it? Maybe, but are you the best person? Probably not. And you probably could, there's a big opportunity cost. Have somebody else do it for you and then go back to doing what you did to get in this business,
I think it's both an opportunity cost and also a risk cost. Is like for us, when we started the company, we basically did, hey, we're just gonna wing this and do it ourselves. And and we did that. But as we went through examinations, we quickly, got corrected. Hey, you guys, this policy that you copied from somebody was obviously a 2,000 person company and you're a 5-person company. Like,
Yes.
it's not everything's adaptable. And you don't, one of the major things that I learned through the examination process is you want to be transparent. You want to show consistency, and you want to show a level of respect for the regulatory authority, meaning like, hey, I'm making an effort to follow the rules. This is a priority to us. And when you're clearly doing something where it's like, hey, I'm cutting a corner or I took a shortcut, it's not viewed. Their level of, hey, all right, you're cutting corners, great. We're going to find every corner that you cut. Like they start to kind of dig in a little bit. And that's why I think it's one of those things where you're outsourcing the cost, but you're also to a degree getting a level of insurance where it's like, hey, something comes up, I'm going to have an examination. I have an outsourced compliance officer that I can go to for any of my questions, any of my needs, and get that kind of help. So.
Yeah, and the one thing I would say on that point is like for any brokers who are questioned that, talk to other people who've sort of been through a one bad exam, right? And when you say that those terms, culture of compliance, right? That they say it isn't a joke. I mean, it sounds like kind of that loosey goosey stuff. It actually matters when you have a regulator who kind of says these guys are cowboys. I don't trust them. The same exact event for that company versus a company they trust, and it can be the same exact event. And one involves hiring lawyers and having 15 calls with them and sending letters, and the other is okay, just take care of that. Those differences, I see them all the time. So having a regulator, they absolutely, absolutely remember.
When we went through our second examination with the state of Pennsylvania, I remember the guy the second time came back. It was the same guy. And he 100, like the first thing he went after were all the things he told us we had to get our stuff, everything together on the first time, which luckily we did. But he also, said, hey, listen, the first time I come out, it's kind of just to give you, some direction. Now it's game time, second time. And that's where they really dig. And they go on your social media. They want to see if you're putting your NMLS there. They really make sure, hey, are your loan officers advertising website that you have registered through your NMLS? Like, they want to make sure the second time around that you're going to put your big boy pants on. So one of the things I tell people, it's like, people look at expenses like this as like, oh, it's $200 a month or whatever it is per month. And they think it's like, well, if I just do it myself and I spend an hour, here and there doing it, I can do it myself and I save this much money per year. It's not just about creating the documents. It's about understanding that you have a go-to, you have somebody that has clients that are going through examinations every single month. And based upon those examinations, they're learning what's changing, what's trending, and they're able to come to you and make sure once you notify them that you have an examination, that you're prepared based upon examinations that recently happened for the next examination. Not, hey, okay, 2 years ago, this is the examination I got. People change, new people come in, people get way more strict when it comes to examinations. We've seen in New Jersey and New York and California, they've established expanded authority, kind of a CFPB at the state level type of situation. Right. So it's one of the things that, it's better to be safe than sorry, I think is kind of the perspective.
Yeah, I agree with that 100%.
So we're going to share a link for Strategic Compliance Partners in the comments here. If anybody's interested in connecting with Ari and his team, feel free to reach out. Ari, we appreciate your time and sharing some information with us. And thank you for everything you do for the broker community.
Thank you, Anthony. I appreciate being here.
Have a great day.
You too. Thanks, everybody. Have a good day, everyone.